Yeah, I have something I wanted to share, but it's both for the intermediate guys too, right? So I just hope they can get on this call. I just hope they can get on this call. I've already tagged it as a beginner call, so perhaps some of them might not actually join. But however the case is, I just give a little time. By 6:20, I will show us what I needed to show us. But first, let's just let's let's go with what we have here. Let's go have here. You can see my screen here. Okay. Mm, wanted to show us something, but before that, I had a talk with one of us that is new, right? So it seems as though fair value gaps have not fully, getting the fair value gap seems to be um, a problem. So I'll go over that. Perhaps I might still show. Let me watch. Let me watch. Over time, I'll see if there are other people. I need to. I need to. Can this thing just disappear first? Okay. But what do you think? These other charts, this is for my eye. It seems I just edit my charts to make it. I make it have a white background, or so talking about fair value gaps, right? Talking about fair value gaps. I was actually doing something. I wanted to show something, but then I'll come to that. Talking about fair value gaps, once I see more persons on the call, so it seems as though getting to know spotting fair value gaps seems to be a problem, or some persons haven't really understood it, right? So let me throw more light here on fair value gaps. Okay, I'll ask a question. Um, okay, there's no need. Okay, these are fair value gaps here. Fair value gaps are basically imbalances that happen in the market. So today we are focusing on forex trading, no HFX, right? Fair value gaps are imbalances that happen in the market, of which we expect the market to get to, react to before continuing a downward or upward movement, right? Fair value gaps always happen after an order block, right? They tend to happen after an order block. Order block is the candle just before a strong bullish or bearish candle. Oh, yeah, it's a candle. In this case, this is another block. In this case, this is another block, right? Before the market moved. And there's always a high tendency of the market returning to an order block before making another move, right? Like you can see here, gave this rise, came back, reacted to the order block, and of course, disappeared, right? Whereas fair value gaps are the gap between three candles, right? The gap between three candles. There's a tendency of the market always returning to a fair value gap before making a buy move, right? Just like in this case, it made a buy move, but it couldn't hold until it got to the fair value gap, right? Sorry, until it got to the other block. So if you're looking for in any of your analysis, right, you're looking for a fair value gap, just candle A, candle B, candle C. mark that space, the space in between them, right? For this one, for let's pick for this one, we have this, right? Candle A, candle B, and any ice cream to be as wide as so that. Okay, you can hear me, right? I need to be sure you can hear me. I need to be sure you can hear me. So I don't just keep talking. You can hear me, right? You can hear me, right? So, right. Sub. So candle B, sorry, candle A, candle B, candle C. You mark the low and the high, right, of the first and third candle. What did the market do? Market taps into this fair value gap, disappeared, right? So I said something. If your fair value gap is too wide, choose the midpoint, right? Choose the midpoint. If it's hard for you to choose the midpoint, just pick your trend line, hold your cursor, right? In fact, if it's hard for you to get the midpoint, it's very hard for you. Select the Fibonacci retracement tool, right? You can search it. It's always here. You tap. You see the Fibonacci retracement tool. Select it, right? Place it at the top of your of the zone you marked out. That's the fair value gap. Select, pick the lower part. I'm coming. Let me eliminate some things that are not necessary here. At least for now. For now. For now. All right. So these are the points you have here. I have 1, 2, 3. Right? You pick the midpoint. This is the midpoint. So since the Fibonacci is showing the midpoint, select your horizontal line, mark that midpoint. Then what next? Take off your Fibonacci. Now you automatically have a midpoint in your fair value gap. Just apply this when the fair value gap is too wide, right? You can either choose, remember, you can either choose the tip of the fair value gap, the midpoint, or the endpoint. I don't always advise the endpoint because you might be chasing a premium market and now miss the whole move. Like in this case, if you are waiting for the market to get to this point, you've actually missed the whole move, right? You've actually missed the whole move. Of course, you got here, moved some crazy pips. This is enough. This is enough profits for you. You can choose this old order block as your TP, or let's just call it this old low. Let's not even speak too much grammar. Looking at this point, this is a clear support, right? You can say, you know what, this support is my target. If I'm selling from here, support is my target if I'm selling from here, right? And now, where is the best place to keep your stop loss when looking at for this kind of trade? Put in your shorts, right? I say you waited because sometimes, yeah, if you set this as a limit order, there are chances that it might not activate because this is like a tip reaction. You just tapped on it and disappeared, right? So let's say you entered somewhere around here, maybe before the 50%. The best place to have your stop loss is just above this high, above the high of the candle, just to be in the safest place. Of course, your stop loss is going to be freakingly wide, but you'll be in the right place rather, right? So ratio 2.33. But are you going to make your money? Or is it sure you're going to give you what you want? Yes, at the end of the day. So you're risking 7.3 pips, right? For 17. For this 7.3, depending on for USDJPY, if you're using if you are risking $1 per pip, this is like $7, and you're aiming to get $17, right? $1 per pip can be 0.1. on your broker, 0.1 lot size on your broker. Okay, what I picked now is the short position, right? You see it's literally right here. We go to forecasting and measurement tools. That's where you're going to see them. The long, the short, right? Long is for if you want to project a buy position. Short if you want to project a selling position, right? So that's why I chose short. Yeah, this tells you where your entry is supposed to be and your supposed stop loss, right? Stop loss above here to know the peep. The peep is, you can see this 7.3 over here. Oh, okay, wait, let me select this so that I see the 7.3. That shows you the peep you're risking, right? Your risk to reward is 2.33, not that much. By the end of the day, are you going to make your profit? Yes. Your TP, 17 pips, all right? If you're risking $10 a pip, this is already $170 and you're risking $70, right? So that is about it. So let's go over other fair value gaps, right? Let's go over other fair value gaps. Now, when taking fair value gaps here, just align it with your trend. Okay, not all, right? I'm just focused on the 5 minutes time frame. This thing you can actually spot it on the 4 hour time frame and keep breaking it down and down and down and down and down and down, right? So for this now, see here, when you're faced with this, another thing you can do is to break it down to a lower time frame. So let's see what it looks like on the 1 hour time, 1 minute time frame. So on the 1 minute time frame, we can see two possible fair value gaps here. You can see one. You can see one, the space between this and this, and you can see the space between this and this two. Okay, let me just point it out for us so you can still see. So it's not as though I'm just talking. We have one, this is another color, so it doesn't was yellow perhaps. Is that yellow? Okay. Just get it, right? We have one. Sorry. Okay, we have two, right? So this is what the 1 hour time frame is showing, the 1 minute time frame is showing us. So the question now is, where can you now enter, right? In this case, you might just excuse this first one, right? Tap into the second. And if you look at the second time frame, it gives you more room even. If you look at the second zone, come on, wait, I'm coming. Okay. Yeah, let me hide this one too, because this one, we are not going with this favorite gap. We are going with this midpoint, this higher one here. Let me just let me remove this, right? So in this case, this is for the 1 minute time frame, right? You can see you can just choose to enter at the tip of your 1 minute time frame. And to enter at the tip, it makes you take a more precise entry, right? Let me make sure I get this. Right? It makes you take, at least if you choose this point, anyhow, you are certain here that your trade will activate, even when spread works on you, or even when you factor in spread difference, right? At least it's not like the tip. The market moves a little bit before going down. And when taking this kind of trade, you might still use this area as a stop loss. Yeah, or you can use this area, however it is. But now imagine you go in here, the market didn't even dance at all, right? The market actually didn't dance at all. Let's say you got in here, the market didn't dance at all. It says to use this, let's say this point as a stop loss, right? Because this is a 1 minute time frame, and you targeted this mark down here. So the same 17 points, but this time risking just 5.6 pips. All right. So what I'm trying to say is that when a particular fair value gap you're looking at is too wide, you can either, like I said earlier, break it into two, right? Divide it into two, choose the midpoint, or you go down to a lower time frame to get a more concise edge, right? Break it down, break it down, break it down. If it's possible, go down to lower than 1 minute, but there's no need for that. Okay. You can see the market just hit your entry, reversed immediately. Right? If you dare to enter at this point, let's say at the midpoint of this particular one here, that's here, right? You were in heat for a while, actually. The market heated you up for a while, but you were in heat. The stop loss, the market danced around your stop loss at least for a very good while. Yeah, before making the move, right? But then here's another approach. If you don't want to take the aggressive entry, right? You saw this. Let me just keep this guy over here first. You saw this move happen, reversed. What you're waiting for now is you just want to be on the right side here. You want to be sure that I call this one jumping on the trend here. You want to be sure that this market is actually reversing before you jump on it. Right? You got here, reversed. What are you aiming for? This guy, just be here first. What are you aiming for? You're aiming for another fair value gap that you can see, where you know that the market will return. And what's the next fair value gap we are seeing here? This one is not really a fair value gap, but it's a zone. You can just have, it's not really a fair value gap. It's as small as what I don't know, right? This area here, between this and this, right? It's not really a fair value gap, yeah? But it's a zone that the market will get to, because what I'm looking at now is this two long imbalance here, right? Though the market tried to fill them, but based on experience, I know that anyhow, this market will still get back to this area, right? So let's say you decide to enter at this point. If you're entering here, for this trade to be valid, right? You don't expect the market to go above this last high. For this your move here to be valid, you don't expect it to go above this last high. So you can give a little room just in case the market then tries to be crazy. So your rule is, if the market hits my stop loss, that means this trade is not valid for a sell, or I am just wrong. Right? So now, have you seen how we reduced a potential 7 pips stop loss to 3.7 pips? But the only thing is that our target pip actually reduced, right? Our target TP from 17, it came down to 14. But think about it. This is the ratio increase. Instead of 2.3, I've been at 2.4. You now have like almost 1:4 reward. So if you're risking $10 here, you're expecting to get $39. If you're risking $100, yeah, you're expecting to get $3.95. Right? So that is it. That's why it's good to always, just break down your charts. Right? If you're confusing on any time frame, go lower. Okay? Go lower. So I believe we have more persons on this call. So let me show us. Wait, is this fair value gap clear now? Is it clear now? Is it clear now? Is it clear now? At least, is it clear to some extent? I'm going to ask. Did I show us one I want to show us? Is it clear? I'm not getting any feedback. All right. Cheers. So what I want to show us is a my approach to trading the news, right? I call it the Newton approach, right? And it's tagged, or the name basically of the approach or the strategy, yeah, is the rule of four, right? So now Coach Michael is our supreme lord when it comes to giving us the best entries for high impact news. Now the question is, what happens after the high impact news? What happens after the rush? What happens after the noise? As a way to trade the market, there are some persons that don't jump on the noise. There are some persons that just wait, stand by, waiting to trade the correction or the next movement of the market, right? And there's a way to trade that. I just want to show us on this session so that next time you can just apply that, perhaps not on your live account, maybe on your demo. Okay. So I'm going to go over, and I woke up earlier around, let's say 5:20 to go over um, some high impact news events, basically NFP in July and August, if I'm correct, July and August. Then of course this month I can get that of this month on our trading view, right? So let me show us. Let me show who is that guy. So news.com, right? You know, this site is where you can go to. Trading view can't allow you um check. There's a limit to amount of candles or ticks you can have on your chart on the free version of TradingView. Yeah, you can't backtest into the past, into like 3 months, 5 months, right? I think on TradingView, I could only access from today's date to August 26th or to be 23rd. So I couldn't do much, basically, right? So let's go to August, August 1, right? There was an NFP release this particular day. Why are you delaying him? Yeah, August 1. Okay, yeah, this is August 1, right? The NFP came out 1:30, right? I call this the rule of four. On the 5 minutes time frame, after the fourth candle, right? After the fourth candle, mark the high and the low. This is a mechanical approach. This is a mechanical approach, right? So when trading this, you trade it like a robot, right? If the market breaks below the fourth candle, you sell. If it breaks above, you buy. It's that simple, right? So in this case, the market came out, of course, the release was 1:30, 1, 2, 3, 4, fourth candle. So this was so perfect, right? And if you look at it, it sold really well. It's now like for you to now know where your target is and you take your TP and you're good, right? So this is for August, right? Let's see, um, 3rd July. This is another NFP. The NFP is supposed to come on Friday, but 4th July is US Democracy Day. There's something they have what they celebrate on that particular day. So for 3rd July, we have this, you can see this massive crazy move, right? Increase the crazy move. 1:30, 2, 3, 4. This is the fourth candle, right? 1, 2, 3, 4. What happened? Of course, must have, let's say you missed this mad move, right? What next? The rule of four. I use this basically when trading my stocks indices. I just had to go through USDPO and see that, okay, it actually aligns to, okay. So what happens next? Market breaks below the fourth candle. Nice sell move. You don't want to target much. Let's say you just want to target, let's say half or some, choose your risk basically and take your TP and you're done, right? Um, I think I didn't do much here. But let's go to 5th July, 5th September actually. That's the NFE. I showed you NFE for July, NFE for August, and let me show you NFE for September. NFE always come out first Friday of the month, right? First Friday of the month. So this is who is that one? Fifth. Okay, wait. Okay, there's an issue I've been seeing with this guy. I can't see 5th July. But anyways, let me show us that of yes, starting with the opening, right? Starting with the opening. Starting with the opening. Today is what? Okay, yesterday was 17th, right? So let's just check that of yesterday's CP FOMC. Okay, this is yesterday's FOMC. 7 o'clock. That was when the market was released. The news was released rather. Right. 7, 1, 2, 3, 4. This is the fourth candle. What am I gonna do? I mark it out. I've not actually done this one. Right. What happened? 1, 2, 3, 4. The market broke the high part of the candle and bought aggressively yesterday. Right. This is what we just caught. We caught like just half of this. We didn't even catch to this point. In NFE yesterday, yeah, we took our profit around 146, 146.00. That's when we took our profit yesterday on the call. So so whatever you think you made, you just made from this move to this, you just took your TP here. You actually missed out. So yesterday would have actually given us like times 2 of whatever we made on that news release. But it's better than nothing anyway. And it's even a very good approach because sometimes on the second candle or the second minute, the market will just reverse aggressively. But yesterday, with the rule of four, 1, 2, 3, 4, right? It's actually a very good move. Okay. That's actually a very good move. Um, today's what? Okay. The last news we now had was 14th and the 12th. That'd be 12, 11 and 12, right? So let me show us that on our trading view. Okay. Yeah, 11. Okay, no, 10 and 11. Okay. I'm seeing some questions there and I'm coming. Why 11? What? To get this one come hard to find. Okay. Oh, 1 minute. I could say, wow, I say why. I'm seeing question. What are you guys joking? What are you guys joking? What are you guys joking? The kind of candles. One, what time frame? No, not 1 minute. Not 1 minute. The 5 minutes candle. 5 minutes time frame. 5 minutes. 5 minutes time frame, guys. 5 minutes time frame. 5 minutes. 5 minutes time frame. 5 minutes time frame. 11th. 1/3. All this I don't even need. Okay. So this is that of CPI, right? CPI was PPI, one of them, trying to say, yeah, this is one that spiked us out. You know, did a spike before going away, right? You can see how crazy it is, right? So, but what happened next? After the fourth candle, 1, 2, 3, 4, the market broke below this little pullback and sold. Okay. If you decide to check that off the previous day, that's the CPI, right? CPI made us at the PPI. I don't miss this. Okay, this is PPI. PPI made us good money actually. Almost see that move now, right? See that move, right? So of course, give us the main first move. We took our profits. They decided to wait, right? 2, 3, 4. So it's an adjust stupid. All right, so just have it. Right. I want to show us there's a crazy one, right? There's one that didn't just actually make real sense. I think that should be one of the PPIs in August. Yeah, it was quite crazy. Remember, all the moves are not this smooth. You can see here, you just made a little move. So in this case, you can choose to just take your profits here. It's still something, right? Take your trade, take your profit at this high, you're out. If it breaks here now, the market kept on ranging. There's no need. Just don't do much. In this case, you broke above, bought for a while, and you're out. Yeah. So that is it. Let me see. August. August. Okay, that's for September, right? I was able to catch one other one. Okay, I've showed us 5th of okay, I've not showed us 5th of September, right? I'm not sure I have. 5th is when it actually was crazy, right? That's the NFP of this month. Okay, this NFP of this month. You can see that on our nice move, we made massive profit from this move. But after the fourth candle, what happened? The market, right? You can see here. So this can see here. I say it's a mechanical approach. Now, your wisdom, in fact, it's a mechanical approach. Let's say you bought here because the market broke this point. You have your stop loss somewhere. You have your stop loss below this area, yeah? And it gets back, takes you out, flip the switch. Like, I know you are long earlier and you've been taken out. Go for a short immediately. You treat this like a robot. If it does this, I do this. If it does this, I do this. It's that simple. Don't add too much emotions to it. Right? It goes because you see this happen. I need to show you this. So you don't think or expect that, oh, it's all rosy. The market doesn't take out the high and now move this way. Right? You can see you enter here, it sold well, did a massive pullback, then continue selling. Right? So you might actually take your profits here and you're done. Right? You might actually take your profits here and you're done. Or can now use your normal trading approach now. If you come begin to do fair value gap, then enter for fair value gap, start with. But the rule of 4 is anywhere that it breaks, it keeps on going, right? So I wanted to show us that before the session comes to a close. Any questions about this rule of 4? Number 1 is the 5 minutes time frame, the fourth candle, the release candle, the 130, 135, 140, 145, right? From the risk candle, after on the fourth candle actually, right? This is an approach I learned earlier this year actually, and is so far so good. It saves you from the wow, look at this gap. This gap will be filled today. Okay, it has been filled already. Are you seeing this massive gap here? It was filled last. Oh, okay. I'm confusing myself. But this gap actually was actually filled afterwards, right? So, family, that is it for this morning session. I just wanted to show us that. So this morning we learned how to take better entries with our fair value gaps, right? And the rule of 4, how to trade the news after the noise, right? How to trade the news after the noise. All right. So, chess family, what have I used this before? Yeah, investing.com. Investing.com. Wait. Investing.com. This thing they block my view. I don't know. This thing is blocking my view. Investing.com, right? Investing.com. Charts, forex charts. Investing.com. Right. It gives you free access. So it gives you free access in this clear. Investing.com. Right. So cheers. Have the best morning and have an amazing day, family. You're welcome.